Well, hey everyone, welcome to this podcast, Cost Volume Profit Analysis, or as I like to call it, the math of what if for modern business. I'm Professor Jeff Byrne and I'm excited to be here with you. In this podcast, we're diving into one of the most powerful tools managers use to make smart decisions, Cost Volume Profit Analysis. We'll start by exploring what CVP analysis actually is and why it matters. Then we'll look at contribution margin, both in total and as a ratio, to understand what's really left over after covering variable costs. We'll walk again through the break-even analysis and introduce the idea of the margin of safety. Next, we'll see how changes in sales, selling price, variable and fixed costs can impact profits. We'll introduce the concept of target profits and operating leverage. Then we'll touch on graphical tools like CVP graphs and profit graphs. We'll show how sales mix affects profitability, and finally, break down mixed cost. All of that through the story of Amplisoft Studios, a fictional Atlanta-based music mastering software startup. It's all coming up in this podcast. We'll meet Amplisoft Studios. They offer a subscription-based software platform that lets artists and small studios upload raw audio and get it back fully mastered using AI. No sound engineer required. For bigger clients, they sell bulk plans. One of their most popular, a Pro Pack, that includes mastering for 1,000 tracks per month. Well, that's our unit for today's vodcast. One Pro Pack for Amplisoft Studio. Let's look at the economics behind this. Well, first, recall what the CM format income statement is, as shown here. Sales minus variable equals contribution margin minus fixed equals net operating income. Here's the data for a Pro Pack. The annual subscription selling price is $10,000 per Pro Pack. Variable cost, which is mostly cloud computing and audio storage, is $6,000 per unit. Contribution margin, $4,000 per unit. Fixed cost of $100,000. So, if they have 100 sales of Pro Packs at a cost of $10,000 each, what is that in total revenues? Oh, you know what that is.
$1 million.
Yes, Dr. Evil is correct. It's $1 million. The variable cost is $600,000, which yields contribution margin of $400,000. Our fixed expenses of $100,000 show that there's net operating income of $300,000 for the month. We can express the contribution margin and its inverse, the variable expense, as both ratios. Variable expense ratio is 6,000 divided by 10,000, or it's 60%. The contribution margin ratio is 4,000 divided by 10,000, or 40%. The takeaway? Well, for every dollar they bring in, 40 cents goes towards covering fixed cost and eventually driving profit. Let's say they double sales to 200 packs next month. The revenue? Well, for 200 packs, it goes to $2 million. Variable expense goes to 1.2, and contribution margin is now doubled as well, $800,000. But fixed cost is flat still at $100,000, brings operating income from $300,000 to $700,000. This is the power of CVP. It shows how profits scale faster than sales once you cover the fixed cost. The foundation for calculating profit equations, well, that's what the CM format does, and it can be expressed mathematically. Here are two ways to model profit. Profit equals price times quantity minus variable cost times quantity minus fixed cost, or simply profit equals the contribution margin, difference between price per unit and variable cost per unit, times the quantity sold minus fixed cost. Or profit equals the CM ratio, that 40%, times sales minus fixed cost. For example, what is the profit if 100 packs are sold from our original data? Well, we know that to be this amount right here, $300,000. Now let's show that using the profit equation. So 10,000 price per unit times 100 units minus 6,000 of variable cost per unit times 100. That's simplified to 4,000 times 100 minus our fixed cost of $100,000 equals a profit of $300,000. Both of these equations work. Just pick the one that best fits the data that you have. Managers sometimes wish to analyze the profit impact of changes in sales. They can do so using the concept of operating leverage. Operating leverage is how sensitive net operating income is to a given percent change in sales. It acts as a multiplier. If operating leverage is high, a small percentage increase in sales produces a much bigger increase in net operating income. It's expressed by the degree of operating leverage, which is contribution margin divided by net operating income. Recall AmpliSoft's CM income statement. Now calculate the degree of operating leverage. $400,000 in contribution margin divided by $300,000 in net income leads to a degree of operating leverage of 1.33. So if sales go up 10% from 100 packs to 110 packs, what will the total impact be on net income? Well, we could redo the income statement, but with the degree of operating leverage multiplier, we simply take 1.33 times that sale increase, and we know that net profit would increase 13.33%. As it does here, profit goes from $300,000 to $340,000. Remember though, this works in reverse too. It cuts both ways. If sales drop 10% from 100 packs to 90 packs or to $900,000, net income would also drop 13.33%. AmpliSoft Studios managers might want to know more than that. They might be asking, what is our break even? Well, the break-even point is the level of sales at which profit is zero, and managers often want to know this in both terms of total sales and unit sales. We can use the profit equations and simply set profit to zero and solve for either units or sales. In the first equation, profit equals unit contribution margin times Q minus fixed cost. Let's use that equation and reorganize it to solve for Q, quantity. What would the quantity have to be to break even? We would rewrite the equation Q equals profit plus FC divided by unit contribution margin. Profit is zero, fixed expenses are $100,000 divided by 4,000, so it would take 25 pro-pack sales to break even. And that makes sense since we have 100,000 of fixed cost to cover, and we know that there's 4,000 of contribution margin per unit. Next, to determine the break-even sales, rewrite that equation as well and solve for sales. Sales equals profit plus FC divided by CM ratio. Set profit to zero plus the $100,000 of fixed cost divided by 0.4, which is the same as 40% as our CM ratio. We would then have 100,000 divided by 0.40, which we would know our break-even sales would be 250,000. Right now, the company is selling 1 million per month. How far can sales drop before the company would incur a loss? Well, that's called their margin of safety. So if they're currently selling 1 million and the break-even is 250,000, the margin of safety is the difference, or $250,000. In other words, sales could drop 75% and they would still break even. Well, that's a solid cushion. If revenues drop, they still got some breathing room. What if they want to hit a 400,000 profit? How much do sales need to be? Well, we just write our profit equations again. This times, we would take profit of the target of 400,000 plus the 100,000 in fixed cost, divide that by 40%, and sales would have to be $1,250,000. In terms of units, how many units is needed for 400,000 of profit? We would simply add fixed cost plus the $400,000 of target profit, or altogether 500,000. Divide that by the the contribution margin per unit of 4,000. So if we're trying to yield a target of 400,000 of profit and also to cover the 100,000 of fixed cost, 500,000 divided by the 4,000 of contribution margin per unit, that would mean we'd have to sell altogether 125 units. Some of the beauty of the CM income statement is that it allows for a variety of quick what-if scenarios. Suppose they're considering a $5,800 TikTok ad and they think it'll bring in 5 extra Pro Packs. Should they do this? Well, let's look at it. If they sell 5 extra Pro Packs, they would get $4,000 of contribution margin per pack, or altogether $20,000 of additional contribution margin. The ad would cost $5,800, which would yield a net gain of $14,200. Should they do this? Well, of course. The CVP can really help us analyze things on a what-if basis to see if this is something we should do or not as a company. Let's suppose that a conference organizer has approached the company and wants to buy 25 Pro Packs, but at a discount, and they don't want the support fees. So should the company do this if they still want $100,000 in profit? Well, the support fees would drop from $6,000 to $5,000, a $1,000 drop. And with special orders, we're making 2 assumptions, or would have to check 2 boxes. 1, does the company have the capacity to take on this special order without incurring any more fixed cost? And 2, by doing this sale, is this a sale that would normally take from sales they might already get? Or would this possibly cannibalize future projected sales? If we have capacity and this won't cannibalize future sales, then the company very well might do this special order if it makes them some money. We can use the profit equation and set profit to $100,000. $100,000 equals a price times 25. We're trying to determine what the price would have to be, minus $5,000 of variable cost times 25 minus 0. It's 0 because we're assuming that in this case there's no added fixed cost because they have ample capacity to produce more units. 100,000 equals P times 25 minus 125,000, the variable cost for these 5 units, or rather 25 units. So P times 25 equals 225,000. What should the price be per unit then? We can solve this equation. P would have to be $9,000 per unit. We could solve this a couple of different ways. If we know we want to make $100,000 of profit on 25 units, well, that's $4,000 of profit per unit. Plus that $5,000 variable cost per unit means that the profit plus the variable cost, our minimum price, would also come up to be $9,000 per unit. Managers also like to show the CVP analysis through a simple graph like the one shown here. There are 3 important lines: the fixed cost line, the sales line, and the total cost line. When only 1 unit is sold, when no units are sold, they still incur that fixed cost of $100,000. As 1 unit is sold, they have that $100,000 of fixed cost plus the variable cost for that 1 unit. As they sell more units, they have more total cost, fixed plus variable. As shown in the green line here is total cost. Notice that total cost exceeds total sales until they go to the break-even point where the 2 lines intersect at 25 units. Sales below this point yield a loss. Sales above this point yield a profit. Few companies sell just one product. They typically have multi-products, and multi-product break-even analysis can be done pretty simply as well. But to do this, we need to understand what the term sales mix means. Say AmpliSoft sells a second product, starter pack mixes. In total, the starter pack accounts for 20% of sales and the Pro Pack for 80% of sales. It has an 80-20 sales mix, which means for every 8 Pro Packs, it sells 2 starter packs. The products have different contribution margins of 40% and 60%. To calculate the break-even, we need to do a weighted contribution margin. To get the weighted contribution margin, we take the 80% of sales mix times its related contribution margin of 40%, plus 20% of the sales mix for starter packs, plus that contribution margin, and we get a blended or a weighted contribution margin of 44%. Assuming the company still has that same $100,000 of fixed cost, 100,000 divided by the blended 0.44 contribution margin means that the total break-even sales would have to be 227,000 and some change. How much would that be for each individual product? Well, 227,273 times 80% for the Pro Pack sales and times 20% for the Starter Pack sales. When a multi-product company is preparing a break-even sales analysis, the sales mix is an important assumption. This sales mix is assumed to be constant. Let's talk now about mixed costs, those sneaky ones that are part fixed and part variable. Amplisoft's cloud hosting bill is a perfect example. They pay a monthly base fee fixed plus charges for server time, bandwidth, variable cost, etc. You can't plan effectively unless you separate those costs into the variable and the fixed portions. And there are two common methods to do that. The high-low method, which I call a PERT-NEAR method, and the least square regression model, which uses Excel and regression plans. For both methods, we take a batch of data, like a data for a year at a time. In the high-low method, we would look at the data and identify what was the high level of activity for the particular month of the year, and what were the corresponding costs. It's summarized here. The high was 8,000 hours at a cost of 9,800. The low was 5,000 at a cost of 7,400. Next, we do the calculation rise over run. Identify cost change, in this case the difference between 9,800 and 7,400, or 2,400, divided by the activity change, which in this case is 3,000 hours. That yields the estimated variable cost per hour of 80 cents. Then, to determine the fixed cost, we simply take our cost formula for mixed, that's the slope of the line formula, y equals a plus bx, and we plug in known variables. We know that the variable cost is 80 cents, and we could use one of our two data ranges here. Let's use the first, 8,000 hours with a total cost of $9,800. Plug in 9,800 for y, and we're trying to solve for x, what the fixed portion would be if we know that we have 80 cents as a variable cost and there were a total of 8,000 hours. In this case, we could plug and chug, and x would equal $3,400, meaning the fixed cost is $3,400 as part of this overall mixed cost. For budgeting and planning purposes, we could also have a cost formula. Anytime we have some future variable number of hours, we could take those hours times 80 cents per hour plus 3,400 of fixed cost and derive what our total mixed cost would have to be. Want a better fit? Use Excel. Plot hours on the x-axis and cost on the y-axis. Add a trend line, and you will have the equation that Excel can then compute through its regression model to come up with the different values. Here, the equation for the trend line is y equals 0.7589x plus 3430. Those are similar values to what we came up with the high-low method. Notice that Excel does invert these when it does the Excel trend line. Excel would also give us an output called an R-square. In this case, it shows the R-square to be 0.90. We know that's a strong fit. R-square shows the goodness of the fit of our equation to what we're trying to solve for. Here, 90% of the variance in the mixed cost is due to the number of units. Since we have different levels of Excel expertise, it's not going to be tested on in this class, but you may find the steps helpful in your own career as a manager, and I'll show those steps in the class handout. It's fast, visual, and Excel does the math for you. Well, let's wrap things up, folks. Let's recap. With CVP, you can predict how profits change with volume, know how much you need to sell to break even, model prices and cost changes, and even decode messy fixed cost. Next time you're building a business case or pitching a budget, this toolkit will be your best friend. That's all for now. Let's go.